Hey, it is Lon Welsh at Ironton Capital, and today I want to talk to realtors who would like to generate more listings and also assist their clients in generating more wealth from their passive investments. So, I've been a realtor for over 20 years. Most of my practice has been helping investors buy and sell investment properties and real estate developments, so we have a lot in common. So, a very frequent issue I'm seeing, and I imagine you've got clients that are just like this, is that they've bought a property, it's appreciated a lot in value, they've almost paid off their loan, and since the loan is at a very low mortgage rate, they don't want to refinance and take out any equity. So there's a huge amount of equity trapped in the property, and yet they're not really generating a lot of wealth on that large amount of trapped equity. So I'm going to show you why it might make sense for them to refinance and do something different, or to sell and do something different. And don't worry about mastering this spreadsheet. If you like the idea and if you have clients with a lot of equity and you'd like to help them by listing their property and selling it, I can do a webinar with you and your client, and I'll explain everything that I'm about to explain in this video, and then you can get the listing and you don't have to worry about learning all this spreadsheet. So the example I want to show you today is a unit that is currently worth $500,000 and the debt is $290,000. So the equity in the property is $200,000. So there's been a lot of appreciation since they bought it. And the first generation of wealth is going to come from the appreciation on the property. So historically in Denver, the rate of appreciation has been about 6% a year over the last 50 years. For the entire US, because many of you are not in the Colorado market, you'll find that 4% is closer to typical. 5% appreciation on a $500,000 house is $25,000 worth of appreciation per year. We can adjust this up or down depending on what market you're active in and what you think is going to happen to appreciation over the next 3 to 5 years. Next, I didn't show you the detailed worksheet here, but I helped this client figure out what kind of cash flow they're generating. In this case, it's not a whole lot. It's $300 a month. You may be in a market where the appreciation is less and the cash flow is higher. A lot of rural markets tend to be like that. I grew up in rural Iowa, and the cash flow on the properties in my old hometown are excellent, but they don't really appreciate very much over time. Denver, on the other hand, tends to not have much cash flow, but historically has had better appreciation. They're all good things. There's no one right answer. So in this particular case, the total return for the investor is approximately $25,500 a year, the appreciation of the property and the cash flow. And if you compare that to the equity in the property, you will see that the total return is about a 12%. So this $25,000 of appreciation and cash flow divided by the $211,000 of equity is equal to this 12.1% total return. So I want to show you the wealth generation that'll happen for the family that owns this rental property over the next 10 years. So the first option is we're going to do nothing. We're just going to keep running this property as we have been. So we've got $211,000 of equity today. And since we're not going to do anything, there's no transaction cost and there's no capital gains tax. So the entire $211,000 of equity continues to earn. And what kind of return can we earn on that? Well, we could do a 12% return is what we just calculated. So we're going to start at 211. We're going to add $25,000 of wealth in the first year, $28,000 in the next year, $32,000 in the third year, $36,000 almost, and then 40. So that's called compounding interest. You're earning interest on your interest. My favorite saying by Einstein is, compounding interest is the eighth wonder of the world. The man who understands it collects it. The man who does not understand it pays it. So you can see this $211,000 of equity today is going to grow to $370,000 over the next 5 years. This is why I believe in real estate, and I'm so enthusiastic about sharing real estate investing with everybody that I can, because it's the way that most millionaires become millionaires. Over the next 5 years, that 375 will grow to 661,000 without any interventions at all. Just taking care of the tenants, fixing things as they break, shoveling the snow, paying the property taxes, things like that. So this is outstanding. If you've got a client that's sick of being a landlord, or maybe they're going to be moving away, or maybe one of the spouses just isn't excited about being a landlord anymore, or they just like to relax a bit, they could sell. What kind of options for wealth generation do we have if they do that? Well, the first is, and this is the first thing most people gravitate towards, is they might put the money in the stock and bond market. So we've got this 211,000 of equity today. We'd have some transaction costs to hire you to sell that property, and then we'd have a little bit of capital gains tax. I did a quick estimate of what it would be for this client. I can also do a quick estimate for your client. I am not a CPA, so of course you'd want to have them validate the rough estimate with their CPA before they made any final decision, of course. The stock and bond market over the last 50 or 60 years on average has returned about 8% per year. Pretty good. So we would be earning an 8% return on about $176,000. That's the amount that's left over from their equity after they sell the place. So that in year one is going to be a gain of 14,000. Second year is 15,000. Third year is 16. Fourth year is 18. Fifth year is 19. So by the time we get to the end of the fifth year, their of the equity that they used to have in their rental house has grown to 260,000. So you can see that is less than the 375 they would have if they continued to own the property. So the gut feeling of a lot of investors is, well, if I sell my property, pay the capital gains, pay the commissions and title fees, put it in the stock market, I'll end up with a little bit less money than I've got right now. And in most scenarios, they're absolutely right. Their gut feeling is correct. Over a 10-year period, they end up with 384,000, not 661. So the advantages for this are if they are just sick of being a landlord and they're ready to move on to a passive stage of life, this could give them that option. Also, it can be difficult to access the liquidity or the equity in the property, and having it in the stock or bond market, you can just take the cash out as you need it. So that's one option. The next option is we have a short-term income fund at Ironton Capital that pays between 8 and 9%. The more you have invested, the more it pays. So I just assumed it'd be 8.25. So we would have these same transaction costs and the same capital gains tax if we use the short-term income fund. It pays slightly more than the stock market, just a little bit. So over a 10-year period, you can see that you wind up with 390,000 of wealth as opposed to 380, just about the same as the stock and bond market. The only thing that's I think a significant advantage for short-term income is that it sends out a quarterly dividend of about 2%. And you can count on that every single quarter. So for older clients moving into retirement that need the cash flow from their passive investments to live off of, this is reliable as opposed to the stock market. Some years is high for the return, some years it loses money. It can be very stressful for an investor to take money out of the stock market if they've had a losing year. It's also very bad for their long-term financial viability. So this takes all that stress out. So for a few clients, that's going to be an answer. Usually, the best answer is our National Diversified Fund. So what I have here is NDF 7. We've already completed raising money for that. We're working on NDF 8 now, but it's all the same concept. Our goal with the National Diversified Fund is to make about 16 to 20% per year. That's historically what we've been able to accomplish. So this is a concept I can explain with you and your clients. So again, don't be stressed about trying to memorize all of this. We have two classes of shares for the National Diversified Fund. One of them has a higher preferred return, but it gets no depreciation. So if your client's investing in their self-directed IRA, for example, many times their CPA will advise that's the best technique. On the other hand, if they're selling an investment property, they're probably worried about, I'm going to have these capital gains. I don't want to do it on the 1031 exchange. I want to get off the 1031 treadmill. The second class of shares gets a smaller preferred return, but it takes all of the depreciation that we generate from the project. Our last couple funds, if you were to invest $100,000, we would be able to generate about a $40,000 to $50,000 write-off in the first year from all the depreciation that we generate. Talk to your CPA, but for most clients, the depreciation we give them can be used to offset the capital gains from the sale of the property. So if you've got someone who's sick of being a landlord and the only thing holding them back from selling is the fear of the capital gains. In most cases, we can solve that problem for you and your client. So in this case, you would still have the transaction cost to sell the property, but the capital gains for this particular client, this is a real example, were cut in half. I've had most situations where I do this for a client where we can offset almost all of their gains, or in fact, all of them entirely. It'll depend on your situation. So if you want to explore this, just set up a quick webinar between you, me, and your client, and I'll help them get the math so they can make a well-informed business decision for their family on how to optimize wealth for their family. So in this case, they're going to have $183,000 to invest in the National Diversified Fund. In the first year, it generates about $31,000. Second year, about $36,000, $42,000, $49,000, $58,000. And by the end of 5 years, even though we had to pay, in this example, some transaction costs and a little bit of capital gains, you can see that we have more wealth, $401,000, versus keeping the existing property and continuing to be a landlord with all the headaches associated with that. And over a 10-year period, you can see it's a very remarkable difference, $880,000 versus $661,000. So it's an amazing situation where your client can get off of the landlord treadmill, stop having to fight with clients and the renovations and the new, at least in our state, a lot of new laws that are very tenant-friendly and antagonistic to the landlord, pay a little bit of capital gains in this case, and still come out way ahead. So if this looks interesting for a way for you to generate new listings for your business and create a lot of wealth for your clients, set up a time for us to call and talk to your clients. I'll walk them through this and educate them, and we can work together to help them have a better financial future. Like Jared, who after 15 months struggling with nonstop with his rentals, he sold many of them to invest passively with Ironton Capital. He says it feels good to have the time back now with passive investments. Ironton made it really easy. Like Jay, who shared, Ironton Capital's helped me reduce the time and headaches I had when I managed my rental. Jay actually sold his rentals, and not only has it made his life a lot easier, we're on track to beat those returns that he had in the past. As John points out, I believe I have moved my money from an unpredictable market subject to many economic factors and significant risks to a fundamentally sound business model that's a hedge against inflation. I recommend them to my friends and family with confidence. Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.